You invested when everything felt like it was falling apart. Let me ask you something personal. Have you ever watched the news, felt your stomach drop, and thought to yourself, should I even bother investing right now? Maybe the market just crashed. Maybe inflation is eating your paycheck alive. Maybe the government is making decisions that make zero sense to you. Maybe there's a war on the other side of the world and somehow your portfolio is bleeding for it. You're not paranoid. You're not being dramatic. The world genuinely feels unstable right now, and if you're sitting there wondering whether this is the worst time in history to be building wealth, I get it. I really do. But here's what nobody tells you. The people who became generationally wealthy, almost all of them built that wealth during a crisis, not after it, not when everything calmed down. During it, when everyone else was panicking, when the headlines were terrifying, when common sense said to run. And by the end of this video, you're going to understand exactly why that is. And more importantly, you're going to know what to actually do about it. Stay with me, because what I'm about to share with you in the next few minutes could completely change the way you think about money, risk, and the future. Let's start with a story. It's October 1929. The stock market has just collapsed. Businesses are shutting down. Unemployment is skyrocketing. Bread lines are stretching around city blocks. People are calling it the end of capitalism itself. Most people did what felt logical. They pulled their money out. They buried cash under their mattresses. They stopped investing entirely. But a small group of people did something that looked, at the time, absolutely insane. They kept buying. They bought stocks at prices so low they seemed like a joke. They bought real estate from families who were desperate to sell. They invested in companies that the rest of the world had already given up on. And then the 1940s came. Then the 1950s. Then the economic boom that followed World War II. And those crazy people, they became some of the wealthiest families in American history. Some of those fortunes still exist today. Now here's the question I want you to sit with for a second. Were those people reckless? Were they gamblers? Were they just lucky? Or did they understand something that most people simply refuse to accept? Here's the truth that the financial world doesn't like to advertise. Chaos is not the enemy of wealth. Chaos is the creator of it, but only for the people who understand how to move through it. And that's exactly what we're going to break down today. Because right now, in this very moment, you are living through a period that future generations will look back on as one of the most significant wealth transfer events in modern history. The only question is which side of that transfer you're going to be on. Let's talk about what's actually happening right now. You've seen it. Trade wars, tariffs going up, entire supply chains being restructured, political instability in places that were supposed to be stable, interest rates doing things that textbooks said wouldn't happen, inflation numbers that feel personal because they are personal. And here's what that does to the average person. It creates noise, overwhelming, paralyzing, terrifying noise. And noise makes people freeze. When you freeze financially, you do one of two things. You either pull everything out and sit in cash, convinced you're being safe, or you just stop. You stop contributing to your retirement account. You stop building. You tell yourself you'll figure it out once things settle down. But here's the brutal reality that most people never realize until it's too late. Things don't really settle down, not in the way people imagine. Think about the last 20 years alone. We've had the dot-com crash, 9/11, the 2008 financial collapse, a global pandemic, regional wars, inflation spikes, banking failures, and a political environment that feels like it's rewriting itself every 6 months. There has never been a clean, calm, perfect moment to invest. Not once. And yet the S&P 500, through all of that, has returned an average of roughly 10% per year over the long term. Through wars, through recessions, through moments that felt like the end of the economic world as we know it. So what does that tell you? It tells you that the market doesn't care about your feelings. It doesn't care about the headlines. It doesn't care about what's trending on social media or what the talking heads are screaming about on cable news. The market has one job, and that job is to reflect the long-term productive capacity of human civilization. And human civilization, despite every disaster, every war, every political catastrophe, has continued to produce, adopt, and grow. That's not optimism. That's just the historical record. Now, I know what you might be thinking right now. Okay, but what if this time is actually different? What if this is the crisis that actually breaks everything? And I want to take that question seriously because it's a fair question. Every generation has believed they were living through the one that would finally collapse everything. Every single one. The generation that lived through World War I thought civilization might not survive. The generation that lived through the Great Depression thought capitalism itself might be finished. The generation that lived through the Cold War genuinely believed there was a chance nuclear war would end human history. And those weren't irrational fears. Those were legitimate threats. But here's what happened every single time. The people who stayed invested, who kept building, who refused to let fear make their financial decisions for them, came out the other side in a completely different position than the people who ran. Not because they were braver, not because they knew something secret, because they understood one fundamental principle that separates people who build wealth from people who lose it during chaos. Volatility is not the same as loss. Let me say that again, because this is the insight that most people never truly internalize. Volatility is not the same as loss. When your portfolio drops 20%, that is not a loss. That is a price change. A loss only becomes real the moment you sell. Every market crash in history has eventually recovered. Every single one. The question was never whether it would recover. The question was always whether you were still holding when it did. And this is where it gets painful. Because most people sell at exactly the wrong time. They hold through the first 10% drop, feeling nervous but staying strong. They hold through 15%, telling themselves it'll come back.
And then the headlines get louder, and their friends start talking about how bad it's getting. And they check their account and see 20, 25, maybe 30% gone. And they sell. They sell at the bottom, right before the recovery. And they lock in the loss that would have disappeared on its own if they had just waited. This is not a rare event. This is the most common financial mistake in American history. And it happens over and over and over again because panic feels like logic when you're in the middle of it. But here's what I really want you to think about. What if, instead of selling during the next crash, you bought? Not recklessly, not with money you can't afford to lose, but intentionally, strategically, the way those families did in 1929. Because here's what a market crash actually is when you strip away all the emotion. It's a sale. It's the biggest, most irrational, most emotion-driven sale in the entire financial world. Companies that were worth $100 a share yesterday are suddenly $50. Not because the company became half as valuable, but because enough people got scared at the same time. And when that sale happens, one of two things is true. Either you're a buyer, or you're the one selling to the buyer. Now let's talk about something more specific, because I don't just want you to give you philosophy. I want to give you something you can actually use. When a country is going through chaos, whether that's a trade war, political instability, a recession, or something else entirely, there are certain types of assets and strategies that have historically performed differently than others. And understanding those differences is what separates someone who survives a crisis from someone who uses it. First, diversification is not just a buzzword, it's armor. When the US market gets hit hard, international markets sometimes hold steadier or vice versa. When stocks fall, bonds have historically acted as a buffer, though not always. When traditional assets struggle, commodities like gold tend to attract attention. The point isn't to predict which one will win. The point is to spread your exposure so that no single event can destroy everything you've built. A lot of people think they're diversified because they own 5 different tech stocks. That's not diversification. That's concentration with extra steps. True diversification means you have exposure across different asset classes, different sectors, different geographies, so that when chaos hits one corner of the world, your entire financial life doesn't burn down with it. Second, dollar cost averaging is one of the most powerful psychological and financial tools you have in a volatile market. Instead of trying to time the bottom, which nobody can do consistently, you invest a fixed amount at regular intervals regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this naturally lowers your average cost and removes the paralyzing decision of is now the right time? Because the answer is always the same. If you're investing for the long term and you have money you can afford to put away, now is always a reasonable time. The worst investment strategy in history is waiting for the perfect moment, because the perfect moment never comes. And while you're waiting for it, inflation is quietly destroying the purchasing power of every dollar you're holding in cash. Third, and this is the one that most people skip because it feels too simple, know your timeline. If you need this money in 2 years, you should not be in the stock market right now.
That's not investing. That's gambling with money you can't afford to lose. But if your timeline is 10 years, 15 years, 20 years, or more, then short-term volatility is almost completely irrelevant to your outcome. The market has never failed to be higher over any 20-year rolling period in American history. Not once. Which means if you're young and you're investing for retirement, a market crash right now is not your enemy. It's a gift. It's a chance to buy more of your future at a discount. The people who will retire wealthy in 2040 are the ones who kept buying in 2025 when everyone else was panicking. I want to stop here and ask you something directly. When you heard this, what did you feel? Did you feel hopeful, or did you feel skeptical? Did part of you want to believe it, but another part of you pushed back and said, yeah, but my situation is different? Because that feeling, that resistance, that tension between what you know intellectually and what your gut is telling you to do in the moment of fear, that is the most important thing to understand about building wealth. It's not about intelligence. Almost everyone watching this right now is smart enough to understand the math of long-term investing. It's about behavior. It's about what you actually do when the world feels like it's collapsing around you. And behavior is hard. Behavior is emotional. Behavior is shaped by fear and by the people around you and by the headlines you're consuming every single day. This is why the financial industry exists in the way it does, because left to our own devices, most of us make terrible financial decisions in moments of high stress. Not because we're weak, but because we're human. And understanding that about yourself, truly accepting that you are not immune to panic, that you too can be swept up in the emotional current of a market crash, is actually what protects you from it. Because when you know it's coming, you can plan for it in advance. You can set up automatic contributions that don't require you to make a decision when you're scared. You can write down your investment thesis in a calm moment so that when the chaos comes, you have your own words reminding you why you started. You can find an advisor or a system or a community that holds you accountable when your instincts are screaming at you to run. You can build the psychological infrastructure before the storm hits. Because the storm is always coming. There is always another crisis around the corner. There always has been, and there always will be. The question is not whether you can predict it. The question is whether you've built yourself to survive it and even to benefit from it. Now I want to share something with you that I think is the most underrated insight in all of personal finance. The biggest transfers of wealth in history don't happen during times of prosperity. They happen during times of chaos. Think about what that means for a moment. Right now, today, as the world feels uncertain and scary and unpredictable, assets are changing hands. Real estate, stocks, businesses, private investments. And the direction those assets are moving is almost always the same.
From the people who are afraid to the people who are prepared. Every panic seller has a buyer on the other side. Every person who cashed out their 401k in 2008 because they couldn't take it anymore sold to someone who turned that position into a fortune over the next decade. The question is never whether the transfer will happen. The question is which side of the table you're sitting on. And I want you to be on the right side. Not because I think you should be reckless or take more risk than you can handle, but because you deserve to understand what's actually happening in the world around you, financially, so that you can make decisions from a place of clarity instead of fear. Because fear is expensive. Fear costs you in missed opportunities. Fear costs you in poor timing. Fear costs you in the compound growth that never had a chance to happen because you pulled out too early. The most dangerous financial advisor you will ever encounter is panic. And right now, panic is everywhere. So here's what I want to leave you with. You don't have to have all the answers. You don't have to know exactly where the market is going. You don't have to perfectly time anything. What you need is a plan that doesn't depend on perfect conditions, because perfect conditions are not coming. You need a strategy that works during uncertainty, because uncertainty is the permanent state of the financial world. You need the mental clarity to separate what is actually happening from what the headlines are telling you is happening. And you need to keep moving forward, even when it's uncomfortable, even when it's scary, even when every instinct you have is telling you to stop. Because the people who kept moving forward during every major crisis in history are the ones we're still reading about today. Not because they were fearless, but because they were committed. Committed to their long-term vision, committed to their plan, committed to the idea that the future, despite everything, was worth investing in. And I believe that's you. I believe that if you've watched this far,
You're not the kind of person who gives up when things get hard. You're the kind of person who wants to understand, who wants to be prepared, who wants to be on the right side of history when this moment eventually becomes a footnote. And that is exactly the mindset that builds wealth. So here's my ask. Drop a comment below right now. Tell me, what is the one financial decision you've been putting off because of everything that's happening in the world? What has fear been keeping you from doing? Because I read every single comment, and I want to know where you actually are, not where you think you should be, where you actually are right now. And if this video helped you see things differently, if it gave you even one idea you didn't have before, hit that subscribe button, because I put out content every week designed to help you think more clearly about money, especially during the moments when clarity is hardest to find. You made it to the end of this video, and that tells me something about you. Now go make it count.